According to Steve Hanke, the U.S. monetary system is unraveling, and he's taught economics for many years. Currently, he's a professor of applied economics at the Johns Hopkins University, actually right down the street from Sachs Realty. And he founded and co-directs the Institute for Applied Economics, Global Health, and the Study of Business Enterprise, also at Johns Hopkins University. He was also an advisor at Renmin University of China's International Monetary Research Institute in Beijing and a special counselor to the Center for Financial Stability in New York. He was a contributing editor at Central Banking in London and a contributor at National Review. He's also taught economics at the Colorado School of Mines and at the University of California, Berkeley. Most fascinating to me, Steve served as a mentor of the Governor's Council of the Economic Advisors in Maryland from 1976 to 1977 and as the senior economist on President Reagan's Council of Economic Advisors from 1981 to 1982. Steve was a senior advisor to the Joint Economic Committee of the U.S. Congress from 1984 to 1988. His accomplishments go on and on. You're going to absolutely love Steve Hanke. I hope you enjoy the show. Steve, you've taught economics for many years, and your accomplishments go on, and I'm honored to have you on our show.
Well, Todd, it's great to be with you, and I'm looking forward to our conversation.
Well, we can start with all of your years of experience in economics. Can you tell me what in the world is happening to the U.S. economy right now?
In a way, it's pretty straightforward, but also in a way, there are a lot of puzzles in the picture. So let's kind of begin by what's straightforward. And I think the best place to start, Todd, is to go back to COVID, when COVID hit in February of 2020. Now, what happened after COVID hit? We of course locked the economy down. Everybody knows about that, but with regard to the fuel of the economy and the real model for looking at the economy, the fuel is what? It's money. It's the money supply. And what we call a quantity theory of money, that is the way in which I think you should be looking at the economy. If the fuel is too great going into the economy, you rev it up, it gets too hot, and you eventually get inflation. And if it cools down and starts contracting, you're going to get a recession, and inflation will fall. And if you look at the transmission mechanism in the United States, it's pretty interesting. Let's go back to 2020, February of 2020, when COVID hit. The money supply actually started going up very rapidly and hit an all-time high in February of 2021. Just a year later, a year after COVID, the year-over-year growth in the money supply was 27% per year. Now that's a record. It's never grown that fast since the Federal Reserve was put in place in 1913. Now, to give some context, Hanke's golden growth rate for the money supply that's consistent with hitting the Fed's inflation target of 2% per year is around 6%. So you can see 27% is a lot higher than 6%. And what happened? And what did John Greenwood and I predict was going to happen? We said inflation might go up to as high as 9%. Well, in June of 2022, it actually went up to 9.1%. So we were pretty accurate using this quantity theory of money. Just keep the fuel, keep your eye on where the fuel's going, and you're going to have a pretty good idea of the course of the economy, not only real GDP, but inflation. And the transmission mechanism works this way, Todd. Once the money supply goes up in a sustained way, then with a lag of about 1 to 9 months, asset prices start going up. And as you know, what in your business, real estate, of course, real estate prices started soaring after the money supply started going up. And if you look at the also the S&P 500 soared. Let's look at the S&P 500 from March 2020 to January of 2022. So we got 2 years there. The S&P went up 114%. Iowa farmland went up by 30.4% in that period, in that 2 year period. So land was going up. What about real estate? U.S. residential house prices went up by 44.43% in that 2 year period. So the first thing that happens once the money supply goes up, asset prices go up after about 1 to 9 months. And then the next thing that happens with a lag of about 6 to 18 months after the money supply starts surging or going down, economic activity starts revving up. In this case, GDP was averaging real GDP growth a little over 4% in 2021 and 2022. So in context, the potential growth rate in the United States sustained for a long period of time is about 2.2%. So it was going up about twice as fast as the sustained rate would be. And then ultimately, of course, you've got inflation kicks in after about 12 to 24 months. So the mechanism, goose the fuel, goose the money supply, asset prices go up after about 1 to 9 months. The S&P goes up, real estate goes up. Then real economic activity starts hitting it and going up at a fast rate, and then ultimately inflation. So that's the mechanism, and that's the way to look at the economy. Now that's pretty straightforward. Now, of course, we're on the downside. The money supply is actually contracting now at a year-over-year rate of about 2%, and actually since March of 2023, it's gone down by about 3.2%. Now, those contractions are just as unusual as that explosion we had on the upside. We've only had 4 episodes of contracting money supply in the United States since the Fed was put in 1913. And those were in 1920 and 22. 1929, 1933, of course, it was contracting then, and we know what happened. We had the Great Depression. By the way, that first one, 1920, 22, we had a big recession. Then, following the Great Depression, we also had a contraction in 37 and 38, and we had a recession. And then we had 1948, 49, we had a contraction and we had a recession. And now, since March of 2022, we've had our 5th contraction we've ever had in the United States. And that's why I think we're in for a slowdown in the economy and a recession later this year. And that's why I also think the consumer price index, which has kind of stalled out the last 3 months, but I think it's going to come down pretty close to the target of 2% by the end of the year or early into next year. So that's the picture that's clear. Now, there are puzzles in the economy, and the puzzles are why is the stock market so hot? If you think recession is coming, and you think interest rates are going to be continuing to go down due to the fact that the fuel is contracting in the economy, and the quantity theory of money, the most reliable guide to looking at the economy, is telling us we're going to have a slowdown, and inflation, although it's plateaued out now at around 3.5%, it's going to keep coming down. So today, where are we at? We're at a very pricey stock market, a lot of exuberance, I think irrational exuberance. The 10-year bond just went up to 5% today. Now, if you think inflation's coming down, bond yields follow inflation. So if inflation goes down, bond yields are going to come down, and the 10-year would be going down, not up. Well, it went up. It's been going up the last few days because everybody's been spooked with this plateauing of inflation. And a lot of people think, well, it's plateaued. It's not going down. We're going to have a lot of trouble. No, it's going down because the fuel has been drawn out of the system. And remember the lags. The lags with inflation, they're long and variable. They can actually be up to 3 years. So to find out what's going to happen to inflation by the end of this year, you've got to go back a year and a half or 2 years, or maybe even 3 years. So that's why it's tricky. If you know what you're doing, it's not so tricky, but it's not always that straightforward. And it's these long and variable lags that get people confused, because if you pick up the paper today, you're just reading what the data are saying today. You don't have any idea what's even happened to the money supply, which is the main thing a couple of years ago. And by the way, most of the press and most of the analysts, they don't even look at the money supply anymore, or the quantity theory of money. That's been trashed. I mean, Milton Friedman and the quantity theory of money is long gone. Most people are not looking at the fuel. They're looking at what? They're looking at interest rates. Well, interest rates are not a good indicator of monetary policy. Changes in the money supply are a good indicator, not the interest rates. So at any rate, that's kind of a little bit of an introductory summary, Todd, for where I'm seeing things, and kind of, you have to have a model for what they call national income determination. And I'm a monetarist, and my model is the quantity theory of money. And it's been the most reliable model for national income determination going back really to the 16th century. I mean, it's been around forever.
Well, if that model is still true today, which I believe you're right, and this is the fifth contraction of the money supply, we may be in for a real ride, and what many say could be worse than the Great Depression because of the amount of money that was printed. I mean, I think we printed more in 2 years than we did in 200 years. And, I'm kind of surprised at why that happened. I understand it was a perfect storm. We had the pandemic, which, where everyone was in lockdown. I think that we overstimulated. I think we, being a business person and watching how, the money was handed out to these companies that didn't even need it, the amount of fraud that was involved, and I don't know if they'll ever go after those people or not. But we were paying people more money to stay home, and disincentivizing them to go back to work when it was time to go back to work, because we spoiled them. We were paying them more money than the employer was paying them, and it's not sustainable. It was just, so when I look at everything that, and wow, I mean, you laid it out perfectly. And when I look back in history, and I'm in the real estate industry, as you know, I'm not an economist, but I do see one of the biggest markets. I have my thumb on the pulse of one of the biggest markets in the world, which is real estate. And it's a very large percentage of GDP. And not that it was intended to be, but it is. And I see the effects of what the supply and demand have had, what the supply of money has had. I'm now looking at things that don't make sense because, as you know, as a professor teaching this, I mean, if you want to own a house, you have to make enough money. I mean, it really isn't hard to figure it out. When we're looking at, the median household income isn't enough, and unless you 7 times, 8 times, 9 times median income to get a median priced home, those numbers end up in disaster. And then what we're seeing, Steve, is we're watching the federal government as the new subprime lender. I mean, they're reducing the standards for people to own a home, lowering the credit score requirements. You can get in with almost no money down, with the lack of supply that we're faced with, we see where, people are making real stupid mistakes by buying $500,000, $700,000 houses, first time home buyers with no home inspection. So, I mean, do you think, honestly, do you think it was a mistake to print all that money back in,
it was a complete disaster, and it was the worst performance of the Federal Reserve in its history, probably with the exception of the Great Depression era. And the reason for that is that the Fed currently poo-poos the quantity theory of money. They don't even look at the money supply. That's not in the models they use. And you have to remember, they didn't predict that there would be inflation. They goosed the money supply without any. They have 785 economists, professional economists in the Federal Reserve System, Todd, and not one of those was able to predict where inflation was going. John Greenwood and I predicted pretty accurately. We said it would go up to 9%. It went up to 9.1%. This was all written out. We wrote many articles in the Wall Street Journal, so even in the popular press, as well as longer scholarly things in the Journal of Applied Corporate Finance, where we laid all this out and saw it because we were looking at the money supply and using the quantity theory of money to do our analysis. So that's what you have. You had the Fed literally flying blind. It would be like if you were flying in an airplane and the most important thing to have on the altimeter was the money supply, and you didn't have it on the money supply. What's going to happen? Well, you're going to have one hell of a crash, which we did, by the way. It's been a roller coaster. Remember, I said that goosing of the money supply was unprecedented, up 27% at the peak year over year. And now we're coming down and contracting the money supply since March of 2023. And what do we have? That's almost unprecedented. There have only been 4 other times where it's gone negative on us. So everything is been unprecedented, and we're on this roller coaster. Now in housing, you mentioned housing, we still have kind of a residual effect going on with the housing, because if you look at the consumer price index, there are over 300 items in the consumer price index, and one that's continued to go up very fast. It isn't coming down. And one reason the consumer price index kind of has plateaued the last 3 months is that home insurance has skyrocketed, and property taxes have skyrocketed. Of course, now you're out in Baltimore County. I'm in Baltimore City. I mean, Baltimore City, remember, we have property taxes that are 2.25%, roughly rounding the numbers off, 2.25%, double what they are out in the county where you are. It's the highest property tax rate in the state. And Steve Walters and I, by the way, who's a fellow at my Johns Hopkins Institute for Applied Economics, Global Health and Study of Business Enterprise, we've written many articles about this in the Wall Street Journal. And what do those articles say? The excessive property tax, the confiscatory property tax in Baltimore City is the main reason Baltimore is being killed. It's a killer.
Well, I can think of other reasons.
Well, there are other reasons, but the core, a core element, it comes back to your industry and your business. It's real estate. And if you kill real estate, you more or less kill a local economy.
I'm from Baltimore, so my dad was a Baltimore City police officer. We're from the Pimlico area, and I love Baltimore, and but I've invested in Baltimore, and I don't any longer because of exactly what you're talking about. The property taxes, but they're not very investor friendly either. And, when on that side of it, that's a whole nother story. I mean, they favor tenants, even bad actor tenants, when they don't pay your bill and you can't get them out. And it takes you 7 months, 9 months, a year to get somebody out. And they destroy your place, and there's very little that you can do. But that happens, over a lot of different cities.
Just a summary on Baltimore and investing, because you're making a point that's pretty interesting. You know the old line, "The trend is your friend," and if you
Yeah.
if you look at Baltimore since let's say 1950 roughly, it's just down, 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 and what was going on in that since 1950, property taxes were just going up, 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 up. I mean, I think we had 24 property tax increases in a row. I mean, they just socked it to them, and that was pretty much the end of the real estate market and the end of the economy. So we're losing population. A study just came out on drug overdoses. This is getting into some non-economic directly, but indirectly it's economics. Drug overdoses in Baltimore are 5.5 times higher than the average major city in the United States. It's number one. The drug overdose rate is number one.
That's sad. Yeah.
So at any rate, I think let's turn to a more optimistic.
Well, I don't know that we'll get much more optimistic, but hang with me here, Steve. But I want to something that is very interesting to me, and when I look at inflation and certainly shelter inflation, when you're talking about the CPI and things like that. I mean, obviously, the Fed. You say the Fed has made a mistake and critical mistake, and I want to say that they have. I mean, when you're manipulating interest rates and you're printing money you're making it out of thin air, basically, and prices are going up. We have a major problem, and that's the lag in salary increases, because that's what's really getting us in a slump. I mean, when you're crashing. Basically the economy now, you can't, employers are not just paying more money. They don't have it. They're being affected by this inflation too. But when I look at the Federal Reserve or central bankers in general, these aren't dummies. I mean, a lot of these are PhD economists. They have, they're smart, way smarter than me. And, and I can see it. I mean, many people can see it. This is a two-part question, because I want to talk about deflation, not disinflation. It amazes me, this term disinflation, and I get it. It's if we wait long enough and stall things long enough, of course we're going to have disinflation. The year-over-year increase is going to be, is going to fall into that 2%. So when we say, hey, we want inflation to be at 2%, obviously, if we stretch this thing out long enough, eventually, if we're crashing the economy, we're going to get there, right? And because people won't be able to charge more money. But number one, I mean, do you really think that they made a mistake, or do you think this is like a bigger plan? And I'm not talking about conspiracy theory. I'm talking about legitimate plan. Was it to raise property taxes? Was it to raise income taxes? Was it to pad the pockets of the bankers, the elites? Why would they do something like this? It seems so clear cut when they made interest rates at zero. Really since the GFC, when they should have let banks fail, but they didn't. And bailouts. I mean, Biden just announced, this Plan B, which I want to talk a little bit about, this student loan forgiveness. But why can't we have, number one, who's benefiting from this? Why did they let it happen? Do you think they're just stupid, or is it a bigger plan? And number two, why can't we have deflation? And what I mean by that, if you ever look, if you went out to buy a flat screen TV, for instance, and you bought a plasma, maybe it was $5,000. You can buy a TV today for, it's not $8,000, it's less, it's $500. You can get a TV. We have deflation on certain items. We grow things faster, we're smarter. Why can't we have deflation? What does that do to the economy? So number one, Who's in charge? Who's getting, is it stupidity or is it a bigger plan? And then number two, why can't we have deflation?
Okay, so you got quite a bit on my plate there, Todd. First, let's actually look at what has happened and why the public is still so annoyed about what has happened. The inflation surge. Okay, now the inflation's coming down. It's down at 3.5%. But their problem is, what was it when President Biden took office? It was 1.4%. Now it's 3.5, and it's going down. The peak I told you was 9.1. But there's been a lot that's accumulated. So for most items, it isn't your television thing where the price has actually gone down for a lot of high tech things. Most prices that most people are paying are a lot higher. They're about 17, 18% higher than they were when COVID hit. So that's what makes them mad. They don't care that inflation's coming down and it's not 9.1%, it's 3.5%. They don't care about that. They care about, well, it was 1.4% when Biden came in and it's 3.5 now. So they care about that, but the main thing they care about is just most things, most, not all, most things they buy cost a lot more than they did 4 years ago. So that's a real noose around Biden's neck, by the way. That's one of the big concerns that everyone has. They're complaining about inflation. Let's say who benefited from all this? Well, the rich benefited. This was all with probably the most left wing government we've had since probably even more left wing, I think, than FDR. Than the new. I don't think the New Dealers were even as radical as the Biden administration has been. But who has benefited? Who really gets the gravy from Biden? It's the rich. Who benefited from those surging asset prices? The S&P 500 soaring. Who benefits from real estate going up? Well, it's people who own real estate, for God's sakes. It's not the little guy who's renting. If you're renting, what happens to you? Well, you have to pay a higher rent. That's what happens to you. You don't get a capital gain off real estate appreciation or appreciation in land or stocks or whatever the asset happens to be. The proportion of the wealth accounted for by the billionaires in the United States has gone from roughly, I can't remember the exact numbers now, it's gone from roughly 17% of total GDP. Their total wealth 4 years ago was around 15%, around 15% of GDP. Now it's over 17% of GDP. So the billionaires really made out like bandits on the thing. That's what happens when the central bank gooses the money supply and you get a lot of inflation. It's people who own hard assets that benefit. So that's part of your question. Now, you say, well, yeah, they are smart people. I mean, they have a lot of PhDs. I told you they had 785 economists working in the Federal Reserve System. Most of them have PhDs, by the way, in economics. The problem is they have very bad models. The models they have do not include measures and metrics for the money supply. The one thing they're responsible for, they don't even have it in their models. None of these post-Keynesian models include money. So their models are bad. And one reason their models are bad is that the universities, for the last 30 years, they've destroyed macroeconomics with these post-Keynesian models. that don't even include money. So they're poorly trained. They have PhDs. They're all at the Fed, and then there is a political side to the thing. And if you look at the staff, the ratio of Democrats to Republicans is 48.5 to 1. There are over 48 Democrats for each Republican on the professional staff of the Federal Reserve. Now, the reason that that's relevant, in my view, is that who is the dean of the quantity theory of money, the chief monetarist in the 20th century? Who was that? It was somebody named Professor Milton Friedman at the University of Chicago, Nobel laureate. Hardcore Republican, advisor to many Republican presidents, including the one I was an advisor to, Ronald Reagan. And who is the enemy number one of all Democrats? Milton Friedman. Even President Biden, before he took office, he said, if you vote for me, you won't have Milton Friedman running the show anymore. That's a quote, actually. So Friedman is a very important guy. And if you're a Democrat, he's enemy number one if you're in the economics realm. So bad training with bad models, a lot of PhDs, fine. If you've got a bad map, think of it this way. What if you're trying to go someplace and the map's off? You're not going to ever end up.
You're
You're
lost.
not going to ever end up where you think you want to be going, and that's their problem. And that's why I insist on the fact they did not anticipate and forecast inflation rate right. John Greenwood and I did. So I'm not. We're not talking about theoretical economics and Johns Hopkins University, that kind of stuff here. We're talking about the real world. And by the way, one thing in your introduction you didn't cover is that I had a mutual fund in Buenos Aires called Toronto Trust Argentina. And in 1995, that was the best performing mutual fund in the world. It was number one in the world in 1995. We were up about 80%. So I'm talking about experience and real world activity here, not some theoretical classroom type thing.
Yeah, it's kind of sad because when you look at, when the U.S. was created, the people were actually in charge of the government. I mean, we held them to a much higher standard. We expected truth and transparency. I mean, we escaped the kings, the rulers, right? And we've gotten so far off of that. I mean, you can't, the things are, withheld. They're covered up in the media. They're not talking about things. I mean, when we're addressing what you're referring to here, why wouldn't we have somebody at the head of our central bank, the Fed, the Federal Reserve? Why wouldn't Jay Powell be required to understand the money supply and, set all the policies to that? It amazes me because
Todd, you put your finger on the problem without exactly articulating it, and the problem is the incentives. Jay Powell, he is not going to get fired because he misses the inflation target. That's not in his contract. So, and in general, think about it this way: all the bureaucrats in the government, whether they're in Annapolis here in Maryland, or City Hall downtown, or obviously in Washington D.C., they're making decisions, but nothing could be more stupid than allowing a decision maker to be giving them the right to make a decision about something where they don't pay the consequences or cost for bad decisions. That's just you don't have to be a rocket scientist to figure out if somebody isn't going to be penalized for screwing up, they're going to continue screwing up. And the problem we have with the Biden administration, the dramatic thing that actually has changed in terms of regime change, is something called industrial policy. And that's something that was articulated in April of last year by Jake Sullivan, the national head of national security at the White House, at a speech he gave at the Brookings Institution. And basically, what industrial policy is that Washington will decide who's going to win and who's going to lose. And all these subsidies that are rolling out by the billions to build chip factories and whatnot, or battery factories, all of this money is being sprayed around. Who's making those decisions? Well, they're bureaucrats making the decisions. And who's going to pay the cost if those decisions are incorrect? You know who will, the taxpayer.
We are.
And by the way, the history of industrial policy internationally, all the scholarly literature shows this. It's a complete disaster, and because the bureaucrats are not very good at picking winners and losers. They don't. You have to be in a profit and loss capitalist system to be incentivized properly and facing a bottom line that it's the survival of the fittest. If you continue to make bad decisions, what happens? You go bankrupt. If you continue to make good decisions, you make profits and you get bigger and bigger and bigger.
I have so many friends of mine that are in the government, and some of them are in procurement, and have been through the years. And it's amazing to me because, they set these budgets. If what I try and do is actually balance my budget and, run with a profit, try and spend less than I make, and try not to take on debt that I can't pay back. I mean, right, you just said it. I mean, that's what we do when we're business owners, where we can't just ask for more money and get it. But it amazes me that they have these budgets set up, and if they don't spend it, I mean, they will spend every penny of their budget as they get close to their fiscal year end. They're buying things that they don't need right now. Sure, they may use it, but they're buying as much as they can because they say if we don't spend the money, they'll figure we don't need that much and they'll cut our budget. So we don't want to have our budget cut. I mean, there's no incentive to actually save taxpayers money or actually, tighten their belt, if you will. And this forgiveness, this debt forgiveness, when you're talking about, and I guess it just kind of goes hand in hand because you need the votes, so you want to take the bulk of the populace, right? And if we can satisfy them and forgive them of their debts and not hold them accountable, like they're not being held accountable, well, then they're going to vote for that kind of plan. But what most people don't realize, it's pretty stupid. I mean, they want the stimulus, but they don't get the stimulus. We printed more money.
The student debt forgiveness thing, you have people don't realize the fifth largest bank in the United States is housed at the Department of Labor, and that's student debt. Fifth largest bank, huge thing, and what they have gotten into is this vote buying. Biden has been very active with attempting to buy votes by forgiving debt. Now, if you work out the numbers, the people who are benefiting the most out of that, by the way, it isn't the little guy, it's bigger guys. So again, this is just part of the game in Washington. The student debt thing is really one of the greatest scams in the United States history. It's huge, by the way. People don't realize. Fifth largest bank in the U.S. is what? Department of Labor, student debt.
Yeah, well, that's probably one of the reasons why, and I don't want to go down this road with you because I'm not saying that education, you shouldn't have to pay for education. I think that you should. And I think that if you get a better education, I mean, there should be, you should pay for that, right? And you should continue to pay for it until you pay it off. You shouldn't take on a loan. But it's interesting because the minute that they started to subsidize the housing, not the housing, the educational, the formal education system, the universities, these student loans. That's when the university started charging more money, and things got really expensive because they didn't have to worry about it. The government's taking care of it.
You know very well what it's what again, incentives. What does a subsidy do? If you subsidize something, you get more of it. So that's what's going on now. Let's talk a little bit about prudent budgeting though, and we have had presidents, some, but very few, who've been prudent. Eisenhower was pretty prudent. Reagan, by the time you take both of his terms, he ended up prudent. But the big one, the most conservative fiscalist we've ever had is Bill Clinton. Bill Clinton ran a very tight ship, actually. Much tighter than Ike or Reagan, by the way. And at the end of the Clinton administration, we actually had 2 fiscal years where we had surpluses. It's hard to imagine. We had actually surpluses with Clinton. And you know what the big complaint then was? The big worry on Wall Street was, oh, there won't be any treasury bonds. They won't be issuing any debt. We're not going to have any liquid capital market with government bonds. Now, what's the worry? Now, the worry is we're going to have such an overissue and this unsustainable fiscal deficit and high debt situation that we're in. We're going to be flooded with treasury bonds. And if we are, what's going to happen? Well, the only way you can issue those things and make them attractive is to have very high interest rates. And by the way, the servicing cost on debt is one thing that's been soaring in the United States. And that interest charge that must be paid, we aren't getting anything. Taxpayers don't get anything for that. That's interest. There's no benefit whatsoever.
Yeah, well, if you talk about insurance companies when you're talking about stimulus, I think about what is happening right now with the amount of people that aren't paying their mortgage payments. And and this is crazy. I mean, when you're looking at if you buy something and you can't pay it, you shouldn't be able to keep it. And I know this is, so what are we doing? We're talking about very sensitive issues because it's the roof over their head. Homelessness is at all-time highs. You said it. Drug addiction is crazy in the cities. We're just giving them drugs and, keeping these people on the street. They can't afford to get in a home, but yet the ones that bought their home are finding that they don't actually have to pay their home. They can have loan modifications. They're taking a third of their balance and casting it into second mortgages, reducing their monthly payment. They're doing everything they can. Now they have all of these bills that are being proposed to make these servicers and these lenders go through all of these workout options before they can actually foreclose. I don't know that that's teaching us anything whatsoever. But I mean, what would you do differently? I mean, when you look at this, obviously you're smart. You're a smart professor. You've worn a lot of hats. Where did we go wrong, and what would you change? I mean, what should we be doing?
Well, as far as the economy and the Federal Reserve is concerned, they should be paying attention to the growth in the money supply. They should keep it at about 6% per year. That would keep the inflation rate pretty close to that 2% target. So that's stability. Now, Todd, stability might not be everything, but everything is nothing without stability. This roller coaster thing, this causes a lot of what you some of the things that you've enunciated. However, I think that mentality has to change, and in this regard, the idea of a small government, go back to the beginning. The idea of a small government is where, and a big private, dynamic private sector, shrink the public sector, let the private sector expand. But that's not the way people are thinking now. They're thinking just the opposite. They think the government somehow is going to produce good jobs, produce income, produce wealth, produce productivity. You name it. You just turn to the government. And you were talking about, what if somebody gets in trouble with their house? Well, the first thing they're going to look at is some government workaround of one sort or another, some angle, and and that is just, I think, leading everyone over the cliff, so to speak. We've already seen what, at the extreme, we went through this with the Soviet Union and any communist regime. You know very well what happens. All of those things have gone down the rat hole at one time or another. Look at, let's take, just as an example, this isn't a theory here. This increase the size of the private sector, shrink the size of the public sector. That's the basic model. Now, who has been the most successful at doing this in the history of the world? China. Deng gave a speech in 1979. He said, we are going to have a opening up of China, an expansion of the private sector. That's what's been going on in China. And if you look at the growth numbers and the wealth that's being created there, and if you do it on a purchasing power parity basis, China is a bigger economy than the United States. If you gauge it in terms of, so it's the biggest economic revolution that ever happened in the history of man. I mean, Adam Smith really wasn't the father of the greatest thing going. It was Deng in China. Now, Chairman Xi, this is going to be interesting. He's trying to turn back the clock. And Xi's plan is not Deng's. He doesn't want to keep letting the private sector expand and let free markets and private property expand. Xi wants the state. He wants an industrial policy along the lines of Biden. He and Biden are thinking exactly the same way, by the way. And that's not the way Deng was thinking. Deng was thinking more like Ronald Reagan, Margaret Thatcher, people like that. Open it up, take the training wheels off the private sector and let it rip.
Are we unraveling? I mean, do you think this is, when you look at most of the empires that fall, I mean, some people say the U.S. isn't an empire, but when you look at
the U.S. is an empire. It's the biggest empire in the world right now, and the most powerful one.
Do you think that we'll see an end of this empire? I mean, do you think that we will unravel?
Well, if we stay on this industrial policy course, this idea that the state is going to run more and more and more things and take more and more decisions. We talked about this before. There's nothing more stupid than giving a decision maker who doesn't pay the cost of mistakes power to make decisions. And that's what they want. They want more and more and more of this. So the trajectory is you said unraveled. Well, it might slowly unravel. I'm not predicting we're going to, go off the edge of a cliff tomorrow or anything like that. But this is not going in the right direction. Now, if you talk to, by the way, a lot of the high-tech people from Silicon Valley and a lot of the artificial intelligence crowd and so forth, they just are so positive you can't believe it. They claim that productivity is going to soar. It's going to solve all of our problems. In short, Silicon Valley is going to bail out the world and the United States in particular. And to tell you the magnitude that they're talking about, and this is one reason you're getting this irrational exuberance in Wall Street. By the way, very few. The breadth on Wall Street's very narrow. It's all in these high tech companies,
Who would
and
all
and
be bust right now with
and
Silicon Valley Bank had the government
yeah.
not bailed them out. So these people that are talking this crap, they would not even be in existence today.
Yeah, well, by the way, that you notice how fast they took their money out of Silicon Valley Bank. so, at any rate, let's give a magnitude of what they're thinking about. I said earlier, the potential growth rate, long run growth rate for the United States, in real inflation adjusted terms, it's about 2.2%, something like that. Say roughly 2%. They talk. Oh no, it isn't 2%, Hanke. It's about 6%. After artificial intelligence solves all of these problems we have, we're going to be booming away at about 6%. I mean, you can eat your hat on that one.
Yeah, well, I guess they hope that it would be so they could eat some of this debt down, but yeah, that's not going to happen.
So at any rate, it's hard to make long-term forecasts. As you know, in the business world, it's hard to make short-term forecasts, let alone long-term forecasts. And we're just having a chat here. We the forecast that we're making, we don't have any skin in the game. You see what I
We don't have any say is probably a more appropriate way of saying it.
say? And somebody says, well, if you're wrong, Hanke, you're going to have to pay $1 million. If you're right, you're going to get $1 million.
Right. Well, one of the things that, and I talk to a lot of precious metal guys, and of course they're getting their fame right now because they've been talking about the dollar collapsing and things like that. And I guess and kind of wrapping up, I want to talk a little bit about globalization, because I can think and list out certainly a lot of reasons why globalization is good, but I'd like to know, what you think is bad about it, and more specifically, the dollar. I know one of the reasons why we've been this superpower, this empire, is because we hold the world's reserve currency, the dollar. But now when we look at, and the big one for me is when I looked at oil trade. Prior to 2023, 100% of the oil trade was done with the U.S. dollar. A fifth of it in 2023 is said to have been not with the dollar currency. So this is new. And then you're talking about China, and not that India and China are friends, but when you start looking at the BRICS nation and this other currency, because they are saying, hey, wait a minute, no, we no longer, we don't want to play by this rule anymore, this currency rule. We're tired of it, and we're coming together. Now, when you look at like Russia and China and North Korea and India and we look at this as, I think this is big. When I look at it and I say, okay, what could happen with that?
Oh, okay, so this is obviously a interesting question. First of all, let's be clear about where we've been and where we are and where we might go. So, where we've been, there's always one international currency. There's always been only one, and that's because of scale effects and a variety of technical reasons. But if we go back, let's say 2,000 years, 2,500 years, if we go back 2,500 years, there have only been 14 international currencies. The dollar is the international currency. Forget all these other currencies. The dollar is king. However, and so it's very hard to challenge a king and knock it off its throne. 2,500 years, only 14 kings. So by historical standards, very well, the average life is 300 years or something like that. They stay around for a long time. They're hard to challenge, but you can challenge them, and they can go bad if monetary policy is bad. British sterling was the king before the U.S. Before World War One, British pound sterling was the king, and the sterling area dominated all the world. Then monetary policy went bad. Britain got into a lot of debt after World War One, World War Two. By World War Two, the sterling was, of course, toast, and the U.S. had taken over everything. So, what could possibly let a challenger in and make the dollar vulnerable? The main thing is we've weaponized the dollar by imposing financial sanctions on everybody. Now, sanctions never work, by the way. They're for stupid people. You say, well, who's running the show? Well, stupid people run the show, because all the scholarly literature shows us that sanctions never accomplish their objectives. Never. Just look at a few countries where we've had sanctions for a long time. Cuba. Did that cause Cuba to change regime? North Korea, Iran, Venezuela, more recently Russia. It causes what's called a rally around the flag effect. It actually makes a regime stronger. The guy in power, there's a rally around the flag, and the locals who are getting sanctioned say, well, the U.S. is our enemy. They're sanctioning us. So we're for the guy. We're for our guy. We're not for the U.S. So this is, and the BRICS you mentioned. BRICS is a pretty powerful group now, and they are viewed as the enemy of the United States, and a lot of the BRICS countries, including Russia and to some extent China, which is in BRICS, they're being sanctioned. So this makes the dollar vulnerable. There's no question about it, because they're trying to figure out an alternative system to get away from the dollar. They're working very hard on this, the Chinese and Russians in particular. So that's where we stand on that. Now, gold has its attractions, because gold it's not issued by a sovereign. It's not a liability of a sovereign. The dollar is a liability of the United States. The ruble is a liability of Russia. The Chinese yuan is a currency that's a liability of China. But gold is a liability of no one. And so it has a certain attractiveness. And by the way, all those 2,500 years that I mentioned earlier, gold has always been in the system. It's always been part of the international system. Now what's happened, gold has just hit a high in the last week, by the way. The gold price has gone up. It's interesting why it's gone up, because if you look at the ETF holdings in gold, they've actually declined. If you look at the Singapore physical premium gold price on physical gold, it's gone down. If you look at the sales of American Eagle bullion coin sales, which are the kind of a primary feature of gold, the gold market, they've actually gone down. So there's a lack of interest, certainly by retail buyers in gold right now. They haven't gone up. What's happened is China. This is a China story. China's buying big time. The central bank in China, as well as central bank in Russia, are buying, but retail buyers, big time in China. The ETFs in China have gone way up, and the imports of gold, Chinese, they're up about 53% year over year. That's just retail imports. So the big bull run is the basis of it is China. By the way, if you look at commodity markets in general, they're all a China story. When the prices go down, it's because of China. If prices go up, it's because of China.
Yeah, it's interesting that you say that. I just had a podcast with Peter Schiff, and he was saying that same thing that you're saying, that it's the central bankers that are buying this gold. They're the ones that are driving the market right now. I don't know. I think, well, it's really interesting because when you look at the pack, the consumers at large, um, when they're against something or they don't believe in something, it's almost like the pack mentality. They think of gold as being this old standard, that we're never going back to gold standard. It's they compare it to Bitcoin now, and they say you should be buying Bitcoin. Bitcoin is everything. Bitcoin scares me to death because when you look at it and you say, okay, why in the world would I want to put my money in something where I can't, there's no physical asset? Do you think, are you starting to teach on Bitcoin? Or is
Oh yeah,
what's your opinion?
I've written many articles about Bitcoin. It's a highly speculative asset with zero fundamental value. Bitcoin is. So if you want to speculate, if you want to go to Las Vegas and speculate, as a classical liberal and free market economist, I have no problem with that whatsoever. But you should have a warning label before you go in and know what you're doing. You might lose your shirt
Yeah.
and more and more. You could get down to the socks by the time you get done with the thing. But right now, by the way, that Bitcoin has had a huge rally. But it's a highly speculative asset that if you have it in your portfolio, you're introducing a huge amount of risk into your portfolio. Even a small percentage, even if you have 1 or 2% of Bitcoin in your portfolio, it really contaminates the thing. But again, if you know the risk and want to do it, and I don't have any problem with that.
Final question. Let's talk about real estate because that is my industry. What do you think? I've been predicting a housing market crash or a price crash, and I've been saying this since the beginning of 2022 when we watched the peak somewhere around May or June. I've been in the housing market for a very long time. I was a builder, developer, contractor for years. I've served 35 plus years. I've served the housing industry. I've seen a lot of ups and downs in the different markets. And, you have some people like Dave Ramsey that says that home prices never go down other than the first time it did in 100 years or post-World War II, which we know is the GFC, the global financial crisis, where we really saw the housing market take a dive, record foreclosures. I also know that had we not saved homeowners right now at well over 1 million homeowners, it's probably millions, but we'll go with 1 million and some of the articles that I've read of homeowners that would have otherwise had a foreclosure already. When we look at the numbers that don't work, when we look at inflation or the consumers lacking cash, money in the bank, they can't afford to make repairs on houses that they own. Credit card debt is, through, over $1 trillion. When we, talk about how student debt's being forgiven because they can't afford to pay it or they won't pay it, and auto loans, or there's more loans in default than they have repo drivers. What do you think is going to happen to the housing market? Do you see us having a major price correction? Do you see where we'll only be for the rich and everyone else will be renting or living in a RV? What are your predictions with housing?
Well, first of all, housing it is cyclical. The idea that it's just always and at all times going up is not correct. The cycles, it's about a 16-year cycle for housing. It goes up and it goes down. So I think at present, in general, it's very difficult to talk about because housing is such a localized thing. So to talk about the average, what's going on in the United States, you're obviously there's a distribution of, you know, some markets are much weaker than other markets, and then you put them together and you get kind of the average market. So it depends on where you are at and where you're at in the distribution. But with the 16-year cycle thing, I would say in general, and with what's happening right now with the money supply, I would say that they'll probably on average be a little slow down. You're not going to see this asset price pop like we had after 2020, 2021, 22. I think those days on average are over for a while. But beyond that, I don't really have much more to say about it, except, traditionally, I'm a farm boy from Iowa, and Iowa farmland.
Yeah, I noticed you talked about the price increases of Iowa farmland.
They don't make it anymore, and it keeps going. And basic the long term trend, by the way, it just up.
That
so
is true.
Land is part of real estate. I know you were talking about houses. Now, how about commercial real estate? You want to talk about tank time?
Yeah, I think we're seeing it. We're already starting to see it.
Yeah, so it depends on what sector of the real estate thing you're talking about. The most stable long-term trend, and by the way, who are the big landowners? Who really? You know who the biggest landowner in the world is?
As far as country?
King Charles.
Oh, okay.
By far. But then you get down into the smaller ones like Bill Gates. I mean, we're talking about millions of acres, but it's Ted Turner. These guys aren't that stupid. So they buy timberland and agricultural land. So that's a pretty safe bet without too much cyclicality in it. And as we mentioned, we're seeing a massive sell-off in commercial real estate right now. I mean, huge. I mean, you look at some of these buildings that have been sold in Baltimore, for example, and I mean, you're taking haircuts of over 50%.
Yeah,
just a few years ago. Residential housing, something else. So getting out in the weeds on real estate is really not my forte. But the general thing at 30,000 feet, I'm giving you. Just remember, real estate 16-year cycle, up and down, up and down, up and down, and part of the reason for that, by the way, is monetary policy and credit. It's something that's very, very driven by monetary policy and credit. So these credit cycles, the real estate goes with the credit cycles. And by the way, real estate's very important and very much hooked up with the business cycle. So the credit cycle, real estate cycle, business cycle, all those things are tied together.
Well, Steve Hanke, we really appreciate your time and all your insight, and we look forward to having you back on our show again. So any parting words of advice for people that are listening, saying, hey, where do I put my money? What should I be doing? Should I be, put my money in physical assets like gold? I mean, any final thoughts?
Well, I mean, we did talk about gold. I should have a little invested in gold. Real estate, I already mentioned Iowa farmland. That's a good one. For a trade, especially right now, this is just a trade, not a long-term investment. Gold is more of a long-term investment. Iowa farmland, more of a long-term investment. Short-term trade, I think maybe the 10-year bond. If the yield is now up around 5%, and you go long the 10-year and buy it for a trade, and you think that Hanke's right, that inflation's still headed down, going down towards 2%, that the yield on that 10-year is going to go down following the decline in inflation. And with that, the price of the 10-year will go up, and you'll have, number one, you'll be clipping a coupon at 5%, but in the meantime, you could have a pretty good capital gain. So that would be a trade.
All right.
Great
advice.
I think all three of those things are probably pretty safe, actually. Nothing is riskless.
Hey guys, thanks for watching. And if you enjoyed the video, you can hit that thumbs up. It'll let Steve and I know that you did. And also drop your comments below. I'd like to know, what was your favorite part about the interview? What do you believe in, or what do you feel strongly against? Drop the comments. We'd love to see them. And if you haven't subscribed to Sachs Realty's channel, consider doing so now. Hit that alert bell. You'll know every time we upload content like this. And do me a big favor, share this video with your friends. It's not something you'll ever hear on mainstream media. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.